review the whole policy. Now, if you're working with an investment advisor that's taking the 338 status, the benefits to you are that you no longer are fiduciary responsible for the monitoring or selection of the investment products. You've handed that off to a 338 advisor. That's their discretion. And so why making sure that that 338 has affirmative fiduciary coverage? Because once you've abdicated some of that exposure, you want to make sure that it can be indemnified in the event that the 338 advisor has a claim. Specific to that 338 coverage, within the policy form is what's called a contractual exclusion. And with that contractual exclusion, it often says that if the advisor, the 338 advisor to the plan sponsor, agrees to take more liability than would have been available had they not had that specific written fiduciary contract, then we're not obligated. Really what that means is the insurance company doesn't want to pay a claim for something that it didn't feel they were obligated to pay, and they're only being asked to pay because the advisor and the client agreed to something in writing. Under 338, the investment advisor is required to give you written fiduciary acknowledgement, so they have to tell you up front that you have coverage. Because of that, what we like to do here at NAPLIA is make sure that the contractual exclusion that's built into the investment advisor's policy is modified, and it can either be removed or say something like, we won't cover any contractual liability that wouldn't have been there not via the contract. However, we acknowledge that any written fiduciary acknowledgement is covered. So now the plan sponsor can be assured that there's not going to be excluded from indemnification. Further, we'd like, if possible, to be an affirmative statement regarding 338 status. So we'd like to see the policy amended to specifically either add by endorsement or changes to the policy that says that I, the investment advisor, has an affirmative acknowledgement from the carrier regarding 338 status. Plan sponsors often ask us, where do claims come from? So let's talk a little bit about where plan sponsors are seeing claims. About 50% of the time, a first-party claim, a claim made against the plan sponsor, plan committee, trustee, is going to be in your non-401k plan. So that'll be in your health and your welfare plans, your dental, long-term care, long-term disability, what other benefits that you're offering. So half the time, you're going to see a claim there. And your investment advisor is only working on the 401k plan. They're going to have no knowledge about some of the other plans that you're offering or any potential claims. So if I'm the investment advisor, I want to make sure my plan sponsor has first-party fiduciary insurance, because I understand that I'm only really working with half of the benefits. And I know from claims perspective that half the claims come from health and welfare. So I want to make sure that they're adequately covered. And again, as mentioned early on, personal assets can be at stake, so it's very important for you to use insurance to indemnify you from that. What I want to talk a little bit about now is some of the questions that I get asked on a regular basis, and hopefully provide some answers that you may be sitting there hearing this presentation and going, well, what about? So let me talk a little bit about what the what-abouts. First of all, one of the main questions that we get is, if I buy fiduciary insurance, can I use plan assets? And the answer to that question is yes. There's no exclusion under ERISA to use plan assets to buy first-party fiduciary. However, we don't recommend it. The reason is that if you buy it with plan assets and there is a payment made by the insurance to make the plan whole, and as a result of that investigation, it's determined that one of the principals, one of the plan sponsors, was directly responsible for that, the potential exists that the insurance company could subrogate against that plan advisor. So there are things called waiver of subrogation. However, our recommendation, because this is not an expensive item, is that the business entity buy the first-party fiduciary. By doing that, we're not using plan assets, so we're not worried about some of the subrogation issues and rules. We often hear the word co-fiduciary, and co-fiduciary isn't a word that really exists under ERISA language. It's been modified over a period of time and has multiple meanings. A co-fiduciary could be your TPA or your investment advisor. But in reality, they may be a co-fiduciary for their acts, but they're not a co-fiduciary for the plan itself or a co-fiduciary to the plan sponsor. So occasionally you may have an investment advisor who says, I want to be named on your ERISA bond as a co-fiduciary, therefore eliminating the need for them to have their own bonding. And here's the problem with that. In the event there's a claim for theft by the bond, or by, the investment advisor, then they're going against your bond to pay it, which may have $500,000 limits, or up to 10% of the plan assets, up to $500,000. And so the issue there is that, again, using your own bond, if there was a subsequent second claim, you have no limits left. Or in some cases where we've seen theft claims, we've seen an advisor and a plan sponsor or trustee that stole money collectively. In that case, if they stole $1 million in money from the plan, and the advisor was named to the plan ERISA bond, then you'd only have potentially $500,000 to pay a claim. If each had their own bond, you may have $1 million in coverage. So we never recommend to a plan sponsor, committee, trustee to add the advisor